Hey guys, it's Nick and Tony with the Sicilian Brothers. We're here today with TJ Kosen. Today we're going to talk about a lot of stuff, a lot of information. We're going to talk about inflation, market trends, where we're going, where we're going to plan to go. Follow along.
Are you listening?
Well, folks, it's time to kick it old school.
You might not even remember this, but you text something in the group chat, and I was like, oh, yeah, I got that. So this is a gift for you. You have to open it.
Oh, shit. Thank you.
It's semi-opened. That's what she said.
Is this going on the YouTube page? Let's see what we got here. Oh, hell yeah. Oh, this is the best. I'm putting this in my office. They don't come bigger? This as big as they come?
That's what she said.
Unless you wanted one for the yard.
Yeah.
Oh,
I'll
all
get
right.
my own one of those.
Yeah.
All right. He's hanging out for the podcast.
Yeah, we could put him on the table for the podcast.
There we go.
He's going to join
That's
us.
the best. Thank you, sir. I appreciate that. That's freaking awesome.
Keeping the peace.
I love it.
So one of the things that we always get hung up on is, I think the first thing that messes with everybody is fear, and I think there's a lot of fear right now specifically.
Are you scared?
No.
Of the unknown? Is that what you're getting at?
Yeah, just fear in the market, right? Like there's a lot of people that are afraid. We get asked every day, like, what's
When's
what
it going to crash?
Yeah, when's the crash? When's the housing bubble? Right? Like all that. And I don't know. I'm trying not to. I'm trying not to get caught up in that. But I think it's a very relevant thing to be conscious of. But like, how do you avoid making decisions out of fear in this market?
I think you're absolutely right. Fundamentally, we're in a speculative business anyway, right? We buy houses that have walls and bathrooms and kitchens.
Yeah.
And then the first thing we do is make them
Tear 'em all
literally worth less than we paid for them because we tear out the bathrooms and kitchens and walls and light fixtures. So we're inherently in a speculative business. And then we compound that with thinking that we're going to be stuck with this thing for good 2 to 3 months. If we're mediocre, 6 months, 9 months, a year. And then you combine that with the market expectation of, well, what's the market going to be doing a year from now?
Yeah.
But I think there's short-term planning and there's long-term planning. And I think you make your decisions on whatever project you're in based on kind of your expectation of what's likely to happen in whatever the duration of that project's going to be. So if I'm going to hold something for 6 months, I don't need to look 2 years into the future and get scared about what's going to happen with, the election or with inflation or with whatever boogeyman I want to pick. I need to look 6 months into the future and be like, well, in 6 months, the likelihood of things changing dramatically is probably not very high. And if it is, hopefully I see it coming inside of 3 months and can adjust, halfway through the process and figure out what that is.
I agree. I think also, since we do buy at a discount, theoretically speaking, if you're in a proper real estate investor, you're buying for less than what it's worth. So at the end of a project, even if the worst of the worst happens, hopefully you don't lose money, right? You might, at least in the way I look at or analyze my deals, is at the very least I can exit, right? So I have multiple exit strategies. At the very least, if something hits the fan, then I can dump and actually liquidate and get our money back, right? Like that's, at the end of the day, that's the base.
I think multiple exit strategies can be key. I think a lot of that depends on the liquidity of the asset too.
Yep.
So in like a Dallas, Texas kind of market, a single family market that we like to play in, then it's a relatively liquid asset in the median home price area. Now, if you go higher than that, it becomes less liquid. If you go lower than that, I don't know if it becomes more liquid, but it's probably not less. And it's not so you can always exit the product.
Yes.
If you have to. And even in a down market, as long as you have a solid financial position, then you're right about multiple exit strategies. Okay, I bought this house. I expected to put $30,000 into it, have it be worth more. Well, the market changes. Now it's not worth more, but it's worth roughly what I have into it equally. Well, what are my options now? My options now are, let's refinance it, let's keep it. And even in a crappy market, even in a 2008 kind of situation, you might not be able to refinance 112 apartments in a Class D submarket, but you can refinance a house.
Yes.
Because that market exists.
And there's more So it's like always appealing to the masses, right? So when you're rehabbing a house, you always try to make it, you don't do it custom.
Neutral colors.
Yeah, neutral colors, right, appeal to the masses. Same thing when you're looking at your rental portfolio. I had this conversation when Julian was on. We talked about like single family houses and how you want more 3 bedrooms than you want 2 bedrooms, just because again, there's significantly more people that want that. So I think you touched on this with pricing, like market pricing. So the lower the value of the house, right? That's a smaller pool than that median income range. That's the masses. And then as you go in the upper valuations of houses, right? That diminishes
starts
in
thinning out on the people that are buying those properties.
Who can buy them or who wants to invest in them or whatever, right? So
well, especially from an exit strategy standpoint, there's always a different market for whatever the product is.
Yeah.
So if it's a rental and it's $1 million house, that's probably not a great rental. But if it's a median home price house that rents for $1,500, $1,800, $2,200, then there's a lot of kind of elasticity in the product area there, and even on down. So on down, I think you don't necessarily bump into as much market risk with lower end products. I think you'd bump into more of the kind of client avatar risk.
Yeah.
Where the lower income, if you can only afford $800 a month in rent, or if you can only afford $500 a month in rent, if you're in a D kind of submarket thing, those jobs tend to be the ones that are more at risk in a deflationary or a declining economy.
yeah.
So if you're making, it's kind of crazy, if you're making $1,200 and you got a kid and you have a 1-bedroom apartment, that 1-bedroom apartment is at more risk than the 2-bedroom house right across the street.
Correct. The interesting thing too is just as we talked about the masses, lenders, right? So that directly correlates to you not having a lender for the 132 unit apartment complex, right? In a down market.
We had one. The problem was the lender went out of business.
But there's always going to be lenders for the house, right?
Yeah, absolutely.
In that median income, right? There's always going to be lenders for that house because it's the masses, right? So there's always going to be a bank or a private lender or something that will finance that median income house.
Right.
That $1 million rental one, there's going to be less lenders for that, and that really low end D property, there's going to be less lenders for that, right? So
I think
it's
so.
it's all kind of the same arch.
Well, the key to all those is there's not necessarily always going to be rentals to burr and get 100% of your money back out again. So the real big key is risk management in any kind of market. And if you're worried about inflation, deflation, stagflation, whatever, or if you're worried about the market changing, the lending market drying up, if you have to pull out 100% of your money in order to stay solvent, then you run the risk of being in trouble. If you realize, hey, in a bad market, I might need to leave 20% into this deal, then either you buy it 20% better. Well, technically you buy it about 30% better because of the 20% of a higher number is less. Is a bigger number. So you need to be prepared if there's an issue to just not be over leveraged. I think too many investors in this market think they have to place all their money 100% of the time, and by doing that, I don't mean that if I have $1 million and I put $1 million on one house, you're not over leveraged. You're still in a fairly liquid position.
Yes.
But if I have $1 million and I'm putting 20% down on however the math is on that, 5 houses?
Yep.
That's going to be a little tough when something hits the fan.
Yes. Yeah, because you're not leaving yourself enough wiggle room, right?
Yeah, I think so.
But we're seeing this, right? We're seeing this, especially in our market. We're seeing this scurry to overpay. I almost did it yesterday, and believe it or not, I talked myself out of it. So, but it was my zip code. It was the one I wanted it, and I
217.
Yeah, and
you buying a church down there?
You are growing, and I'm so proud of you that you turned that down.
Yeah,
He said no to a deal.
Yeah,
he saw a
yeah,
house he
so-
didn't want to buy.
It just 24 hours earlier, I made an offer, and then 24 hours later, they came back to me that they had so when I made the initial offer, they had a higher offer. They come back to me yesterday, 24 hours later, and said, "Hey, I'm going to give it to you for $5,000 less than what I offered the day before," and I still turned it down. So
Damn.
That's
impressive for you.
That's a pretty big thing
That's
for me.
impressive for you.
But I think
Why?
Kelly.
I'm intrigued now. Why? What? Was there something about the property, the location, or
It was the price point, the barrier to entry to what I do with
risk?
75217. The risk was just I could have taken that same 200,000 and put it into 2 or 3 other houses and made more than that potential I would have had on that one. So it was just don't fall. Get out of the emotion of it and look at the business side of it.
You think we're good on North Dallas, right? You think we're good on our house so far? We bought it okay?
We're gonna. I think it's probably gonna be your.
it's all the
your
dead
best
squirrels
deal
that
you-
were sacrificed in that house? That's what's going to make it a killing.
I think it's gonna be
A killing.
I think it's
from
gonna,
the sacrificed squirrels,
Yep,
killing
exactly.
dead squirrels.
You're going to crush it.
Never mind.
We should.
It probably should get crushed. It's a
We
bit.
should throw a video of the collection you got going on the mantle in this video.
I think it's going to add up.
I think there's going to be more. Kelly Smith and I were talking about this sometime in the last couple months, where it's really frustrating because investors are so spoiled. So if you're old enough to have survived the 6 to 11 market.
Oh, I'm getting flashbacks, man. PTSD setting in.
Yeah, no, you start to cringe, right?
Uh-huh.
But if you were around in that market and you're here today, I feel like you should have a different mentality than, say, the investors that came in 11 till today.
Yeah.
And that being said, because I remember where, hard money rates were, let's just call it 15, 16%, right? And now you have hard money rates at these teasers, 699, 799, 899. And I think that's, and it's great, and maybe it helps the deal be more profitable, but there's something to be said about having sure money. We have this conversation all the time because, I use private money, that I'd rather pay for consistency than go get the teaser rate for 3 or 6 months. But investors are so spoiled right now that I feel like they're taking the bait of the cheap money, and then they're paying 80, 85%, and they're breaking their buy box because the fear of the market right now is, oh my gosh, I have to put that cash to work, or oh my gosh, there's so much free money. It's just this like that's the word I'm looking for, like
You're going to miss out.
yeah,
Yeah.
yeah,
Yeah,
That's
you
the
get
FOMO.
you get the FOMO thing.
Yeah. Fear of missing out.
Yeah.
I
That's
think
a term for that.
FOMO. Put
Yeah.
that definition on the screen.
I think there's a lot of that. I think there's a lot of ability of people to over leverage and overpay, and I think that's a greater risk than what might be a market risk, at least in the short term. Now, in the long term, you can project out, like I said, 6 months or maybe longer if you want to look at monetary supply. But right now, we're selling a house, and we're selling it to someone that's getting a hard money loan and a second on the loan. And then who knows how they're going to pay for the renovation. I have no idea. I don't really care. But it's closing today and it's getting sold. So from the selling standpoint, it's awesome because
Yeah.
we're really good at getting deals.
Yeah.
And we're pretty good at every like step of the process. But so when you get good deals, it's great to sell. We went down our board on Monday with all the rehab projects that we have going on, and we haven't updated ARVs because once we put them on the board, we don't really bother updating an ARV on a rehabbing house.
Yeah, I
We
don't
just-
do that either.
We just list it.
Yeah.
Have
Have they been jumping lately?
Yeah, we went just on Monday just for fun. I went down the board and we added probably 120K worth of projected profit just on rehabs that we have based on adjusting ARVs to current market.
Yep.
And we bought these houses, 2 to 6 months ago. I think the longest one we've held is 6 months. So we didn't update it when
Just
when
to
we bought it.
clarify, so you, I want to make sure that I understand. So when you buy a house, 123 Main Street, you think it's worth 100, you bought it for 50, whatever, right?
Yeah.
You don't touch that valuation until you're done with it and you're ready to sell it. Like
Yeah.
you don't,
Well,
you
we
don't,
we don't change it on the board.
Right.
For
You
me,
don't-
anyhow, once we buy a house, it's about what the exit strategy is, and it's about getting it to that exit strategy
as fast as possible,
as fast as
relatively
possible.
speaking. Yeah.
Much more importantly than what the actual, whether or not we're actually even making money. I mean, we tend to.
Yes.
But
Hopefully.
if you have an exit strategy in mind, then you have to do whatever the rehab takes to get it there. So if you miss something on your due diligence, if you miss a HVAC being bad, if you miss a roof being like half blown off, if you miss a foundation by a couple $1,000s, it doesn't mean that you don't do those pieces.
No, you do.
It means that you absolutely do them, and it also means that you probably make less money. Now, in a going up market, you're kind of insulated from that effect.
So we've talked about this because
You can
Any
fail
f-
upward right now.
any fool can
Yeah.
make money right now.
Yeah.
If they
Anyone.
can buy right.
Right. But
they
even
can
if
buy
they don't
right.
buy right.
Well, that's true, I
They're
suppose.
especially in DFW, you're getting lucky right? You can hold a house extra time. I think you kind of proved this point on that one house where you had to evict
Church
somebody.
house.
The pastor's
Pastor house.
house,
Oh,
right?
yeah, it's full
right.
like-
You had to hold it. Let's just say a year longer than you would have thought, and you were able to. In that year, you were like, "Holy crap! I got 20% more for the house," right?
Yeah.
So any fool can make money right now,
That being said, we bought it such that it would have been money either way. But
but more money, right?
but we did make more money because we held it. Yeah.
It is just, it's crazy right now. We just did I'm doing a refinance. Client appraised the property. It was my appraiser. I appraised the property in December, 271. Client backed out for a little while, had to get some personal stuff sorted out, came back. We just finished another appraisal because it waited 6 months. Second appraisal came in. Client didn't touch the house at all. Came in at 320.
$50K
$50,000
for
in
sitting on it
6
for 6
months.
months.
Not doing. And tenant's been in there. Tenant's been taking care of the property. He didn't do a thing.
What does the investor do in that case? Do they pat themselves on the back for a job well done because they bought,
'Cause
7 months ago?
yeah, and-
or do you sit back there going like, oh crap, what's going on here in this market?
Well,
it's just
that taps
silly.
back into the fear, though. I think people are making decisions based on the appreciation, right? And there are some indicators in the market, at least from the little bit of news I do track, that says that, hey, maybe we're not going to see a drop, but I do think let's just isolate Dallas. I do think Dallas is starting to settle. Like if you were to take it from like a high boil, right? We're now at like maybe a simmer, right? Like we're at a rolling boil, and then maybe we settle down to a simmer. If you use cooking analogies, it's not that you cook, but
I cook fantastically. What are you talking about?
but I do think we're not at that raging boil, right? I think we're
any like quick drive up in a market. We see the graphs of crypto and stuff, and you think stuff spikes up and it automatically spikes back down. You think of 2008 and you think that it spikes up and then it automatically spikes back down. So 9, 10, we saw real estate in California, because I'm from there. We saw it spike up, and then we saw places that drop down 50 to 75% in value. So how do you hedge against that and protect against that? The answer really is you kind of don't. There's just so much misery when that happens that you're in the same boat. I don't think that's going to happen again.
I don't see that happening.
There's also the market dynamic of a consolidation and a price pattern on a stock graph. So I think what we're likely to see in at least the North Texas kind of market, and probably most of Texas and kind of the Midwest, is not a spike up and spike down. I think we've seen a spike up. I think we're likely to see kind of a price consolidation around these areas, maybe with a little float down, kind of.
Like a plateau.
But I think that's not an unreasonable expectation. We saw a mini one in 2015, 16, something like that, for about 6 months. It kind of like fluttered around, or it wasn't sure what it was going to do for a little while. And it was a consolidation. It wasn't a crash. So I think people in the market tend to think that, it's a boom and bust. It's a up and down crash. Well, some assets are, and some asset classes are, and some market dynamics are, but they're not always following the same. All assets aren't always following the same pattern all the time.
I think for far too long, the average investor has looked at the stock market and used that whatever graph and tried to apply it to real estate.
Yeah.
It does not. They are not the same. Which I think we're seeing that you're starting to see funds out of the stock market buying massive chunks of real estate.
Right.
Because I think even those geniuses on Wall Street have realized that, this isn't the same, so let's grab some of this dirt before it's all gone.
It's a lot harder to panic sell a house than stocks and stuff. So
And so there you see D.R. Horton built a subdivision, an entire subdivision, and instead of selling each house, they turn the entire subdivision into a rental, and they made, make up a number. I don't know the actuals on it, but they made $1 billion more than they by selling it as a portfolio of rentals than as selling them as individual single family to the buyers.
Well,
right.
what's really popular in the smaller development space is doing the duplex, the fourplex rent to own subdivisions, because the build cost is a little bit lower on a per square foot basis.
Sure.
Because you don't have as many exterior walls in a fourplex as you do in a house. You don't have the same insulation necessity, that kind of stuff. So it's a little bit cheaper to build. And the cash flow, interest rates are so low right now that the holding power isn't even keeping up with inflation. The interest rates are where they're at.
Yeah.
And so that's the question that we probably ought to have a discussion on. Is what's the cost of money, and what's the cost of keeping cash, or what's the eroding cost of keeping cash in your pocket right now?
I think that's definitely the segue is, I guess we're all right talking about using the word inflation. No one wants to say it. You don't hear anyone talking about it.
Because no one understands it. No one knows what it is.
I agree with you. I don't think people understand the definition. I think they know it as, that they know the word.
It's like, prices are going up. It's inflation. Well,
right. And there's a difference between hyperinflation and inflation, right? And so, but one of the things I think that referencing fear, where we started the conversation, I think the fear of inflation, I don't think people are, I said this to you yesterday or the day before, I don't think people even realize that they're making decisions based on fear of inflation, and they might not even understand what inflation is, but they're making these decisions based on something that they don't understand. They just know it's coming, or they feel it, or they go to the grocery store and the price of beef is 3 times what it was this time last year, and they're like, oh my gosh, stuff is costing so much more money. So what's inflation?
What's inflation?
Yeah.
Well, I think depends on who you ask, is what's inflation, right? So there's the definition of what's included in different inflation products. There's causes of different types of inflation. And then there's also the velocity of inflation. So there's basically 3 parts of inflation. I think the easiest one is to start with a definition that people generally get kind of not right. So inflation, just by itself, overall inflation on a macro level, is prices increasing more than wage and economic growth is causing inflation. So technically, if economic growth is keeping pace with inflation, then there's not actually overall actual price inflation. So that's kind of the definitional thing.
So if the average person is making money as prices are going up, if their income is going up as prices are going up, that's not necessarily inflation.
That's right.
Right?
That's right.
So,
that's just growth.
That's just growth.
Right.
We're not seeing. I don't think that's what we're seeing right now. That's if you were to ask my opinion.
I think we're not seeing that. I think we're seeing
prices going up.
I think we're seeing something actually that's potentially more dangerous than all of those. So that's the definitional thing of inflation. The confusion in the marketplace about the definition is the way the federal government tracks inflation. They track core inflation and they track CPI. So core inflation is what people actually generally consider CPI. Core inflation is the inflation of consumer-based products that aren't including commodities, aren't including lumber, aren't including like gold, silver, gasoline, that kind of thing.
Right.
So that's where people say, well, I mean, obviously inflation is really bad because gas prices are up 30% since this time last year or whatever. What the government generally considers inflation is actually CPI, and that does include the consumer products. So that includes lumber, that includes everyday buying products. So that's where people worry about, inflation's out of control and the government's not reporting it. Well, it's calculated in there because they have they call it a basket of goods that has a weighted average based on what they project people spend on these different things. So you could argue about the weight between lumber versus gasoline or commodities or crude or whatever. But it is included in there. So then, are they actually including it correctly? Well, that's the $1 million question. And realistically, it doesn't matter because if I'm spending $8 for a 2x4 when I'm accustomed to spending $2 for a 2x4, that's going to affect my business.
Right.
Now, if I'm spending, what am I spending? $3.20 for gas for premium, right?
At least, yeah.
Where I was used to spending $2.20 for gas, that's not going to affect me personally, but it is going to affect the average American personally.
Sure.
So
they went from $1 again. They went from $1.60, $1.70 to now they're paying almost, $2.80, right, for regular. I think it was $2.87 or $2.89. I think I paid yesterday for the truck. So
gas seems to be up, I think, about almost 50% in a year, which is insane.
So is that? Does you think that's perceived inflation, right?
No.
Where I was going with that though is like the average person when they see when they see that they're paying more for gas. If that's not direct inflation, do you think that that's just like that's scaring them?
Yeah, I think so. And touching back on core inflation versus CPI, core inflation, not including commodities, is really interesting. So that actually tends to skew it to other things you don't really understand that aren't inflationary by nature. So you think you have an iPhone, right? An iPhone, as far as I can tell, has been $1,000 for the past 15 years.
Yeah.
So how do you figure out what an iPhone is worth when it's a deflationary product? The newest, greatest version comes out, and it's got a better camera, better mic, better everything, and it's priced maybe $100 more, but it does a lot more stuff. How does that figured into the marketplace in terms of an inflation aspect? Maybe it's $1,200 instead of $1,000, but my iPhone 1 is worth $100. It's probably not even worth that. I don't even know if you can give them away. They're probably a paperweight at this point. But how does that affect the real estate market? I'm not really sure. What we probably ought to talk about really is the different causes of inflation, because the different causes of inflation tend to lead to what is actually a driving dynamic in the velocity of inflation, and that's where like growth inflation versus faster inflation versus hyperinflation kind of come into play. There's different causes to inflation. Everything in the marketplace, even in a free market or even a not free market, is still based on fundamental supply and demand.
Yes.
So you can constrain supply, or you can artificially keep prices lower to a certain extent, but that has kind of cascading effects in the marketplace in other areas, and also in that asset class once that is released. So I don't know. You want to talk about like causes of inflation, I guess, or types of inflation?
What about without going over everyone's head? You threw some
Big words in there?
Yeah, some big words in there, right? And it's like, all right, well, before we jump into the deep web of it all, what is it that makes, on the surface level, going back to real estate, because that's what we do. We're buying a house. Take the house on, PV that we're doing. You bought it for, whatever the number you bought it for, and we're going to invest money, and we're going to fix it up, and we're going to sell it.
Right.
You think that was a 6-month flip, something like that, right? People keep asking us, me, you, whatever, when we're at an event, aren't you afraid to keep throwing money at that house that's worth $650? Like, Tim, TJ, doesn't that scare you? Like, what's going to happen?
$685.
What's going to happen? What if the market crashes, right? And I keep explaining to people that we're not going to wake up tomorrow.
The bottom's going to fall.
And we're not going to wake up tomorrow, and that house is not going to be worth what you paid for it.
So what I think people are seeing and what they're projecting into the overall real estate market are kind of two different things. So what people are seeing is a 3, 4, 5, 600% increase in lumber prices. That's inflation, but it's not a long-term inflation. So that's what's going to be called a supply constraint type of inflation, where there's demand inflation, supply inflation are the two kind of fundamental inflations, and then there's inflation that's caused by changes in monetary supply. So what we saw in lumber, what we even see in gasoline to a certain extent under the Biden administration, is constraints in the supply.
Yeah.
So does that mean there's less trees? Not really, because trees are a renewable resource, despite what some folks think. You can plant more trees. Now they take a while to grow. Yeah. But they grow actually pretty quick. So when there's a disruption in the supply chain because of an event like COVID, because of an event like a hurricane on the coasts, when there's any of these events, when you shut down building of a new pipeline from Canada to Texas, that's going to constrain the supply, and it's going to increase the price.
Yeah.
When you have a whole bunch of people in warehouses taking off because they get COVID or whatever, it's going to constrain the price. It's going to cause prices to go up when demand stays stable, and it's even going to cause prices to go up when demand goes down, because I think if supply is going like this and demand is going like this, right, prices are going to go down. If demand is staying relatively stable but supply is like this, well, then price is going to increase.
Yeah.
Worse than that, price is going to increase, and you're going to have a shortage of supplies. So,
well, when we're seeing a shortage of supply,
yeah,
and
absolutely,
labor,
absolutely.
But we haven't lost really we haven't lost humans we haven't lost humans that can actually work. We just have lost labor pool.
Well, I think there's a lot of laziness in the labor market when the average employer, when the sandwich shop owner is competing with the federal government on a paycheck, and the federal government is offering you can stay at home and not work, and I'll give you money.
Yeah.
And the sandwich owner is saying, you got to come make sandwiches for me, and I'll give you money.
Yeah.
Which one are you gonna do?
Yeah. No,
I mean, I don't blame the guy that's trying to make sandwiches.
I
Yeah.
really love sandwiches.
I do.
Yeah.
I like sandwiches.
yeah, but I agree. and anywhere you go, I mean, we stopped for coffee on the way here, and
It's empty.
everywhere you go, there are signs we are hiring. You know, like and it's insane, right? So, how that interacts with our daily business is what's stressful for me, because people are making very rash decisions based on the fear
Right.
and the noise and not necessarily logic, right?
So what I think we're seeing right now is back to the real estate market and back to what changes things and impacts our industry on a macro and long-term level, and why people that have a lot more money than us. So hedge funds have been on the market buying stuff in Dallas for years. I got friends that do 300 houses a year for certain hedge funds, and they've been doing it for years.
Yeah.
But what's new is seeing a lot more funds and a lot more Wall Street kind of money coming into markets, not just like Dallas. We're seeing it in Dallas, we're seeing it in Houston, Austin, all of Texas, obviously.
Yeah.
But we're finally starting to see it on a smaller submarket level too, where they're buying smaller houses in smaller submarkets, which is really an interesting new phenomena
Land
in the market.
They're buying. Like we said, they're buying
Not even-
subdivisions.
Right.
Yeah, like they're
not
buying
stuff that's
dirt.
desired,
And
not desirable
in,
stuff.
in transitional areas, and as you're calling it, submarkets, right? Those that out there know DFW know that Waco is probably the most popular submarket off of DFW, right? It's
Right.
just because of the TV show
Yeah.
and stuff like that, right? But in between Waco and Dallas are a dozen towns that have skyrocketed in pricing and being like less affordable, just because they're driving the price up, because it's the dirt in between the submarket, the hot submarket, and the hottest market, right? So
So what's causing that is a bunch of fold. On the individual level, what's causing that is a lot of free market a lot of free money in the marketplace. So to answer the actual question, is in the last 12 months we've basically printed 25% of the monetary supply in the country. That's not a stable thing to keep doing without having it have an impact on the overall market. By that I mean everything in the market.
everything.
Yeah, everything.
Everything.
You can't print 25% money and expect it to not have an impact in the marketplace. So the immediate impact of that is investors' funds having to place money in order to maintain an ROI that they're accustomed to, and realistically probably maintain a somewhat lower ROI. So,
Oh yeah, no. So as liquidity goes up,
right.
everyone gets okay with a lower return.
Absolutely.
Because
it's easier to get money.
Because
So now
it's
I can do
easier
more
to get
deals.
money, so I could do more deals. But then the investor that's placing the money is competing to place their money.
Right.
Right.
So that investor. So then what we're seeing is this money is already saturated in a market like DFW. Like everyone knows, DFW is a solid
Sure.
economy, a solid employment base, a diverse economy, and just a growing area to be because of a lot of different reasons. So this is already saturated. So people like us are then looking outside of DFW to Waco, to other smaller towns that are kind of on the outskirts of a metroplex area.
Yeah.
For short-term gains, for renovations or for rentals, and so I guess the question is, what does that do long-term? That's a different question. So basically, what we're going to see in the short term is continued inflation, I think, in the real estate market. Now, hyperinflation is, I think, technically defined as some insane increase, like thousands of percents. We're not going to see something like that.
Yeah, it's I think it's actually like 50%. It's something crazy, like where it equates to like 1,000%, but it's like 50% increase month over month.
Yeah,
It's something silly like that, right?
Runs away.
that's not terribly likely, even with our kind of reckless economic policy,
Right.
for a lot of different reasons. But we are going to continue to see the need to place that money here. Now,
Do you think we reference Texas, certain states as bubble states, like they're kind of in their own little pocket? Do you think Texas is isolated? And it's odd because I think what we experienced in 8, 9, 10, 11 was, you could fart in Greece and it would totally destroy California, right, or New York. Like you could do something in the other side of the world and it completely hurt the United States. Do you think called Texas a submarket of the 50, right? Do you think we're subject to similar pains kind of going into the next, let's just say 2 years, because the rest of the world isn't open or they haven't opened or right? Like we're talking about lumber. A lot of the lumber comes from Canada, right? And it gets across the border or comes from the northern states and drives down. Do you think as those countries remain closed, it's going to cause us to have like stagnation?
I think, I kind of think not. I think Texas is susceptible in the higher end markets. So what drives the real estate market is obviously price, but to a certain extent, and so what drives price is two different things. It's A, affordability, and B, demand for the product. Now, as affordability increases, it tends to also increase the price of the product because more people then flood to that area and have the demand for the product.
Which you're seeing on your houses where houses come in, you list it for 200, and like in our situation, we listed it for 199.9, and we got a 225 cash offer, right? Like,
right.
You look at that and you're what? And I actually, when I did the comps on that house, it was 160 was like what I thought I would max out, and here we just sold it for 225.
Right.
So that's access to money that caused that, and then lack of product that caused that, and so I was just trying to tie it back into housing.
Right. So in that case, the key that you said there, you don't even realize, I think, is that it was a cash offer on that house.
Yes.
So when people try to compare the market we're in right now to 2007, 8, 9, 10, is there wasn't a lot of cash offers on houses, especially coastal areas, especially San Diego, especially Los Angeles, New York.
Cash offers. I mean, in 9, 10, 11, my listings were on the market for 365 days, 400 days. You were
You
going,
had a party at it.
yeah, and you were going to, we'd go to happy hour when it hit 365 days, like we celebrated. It was insane. But then you had the, for lack of better words, you had the government doling out down payment assistance money just to try to get that inventory sold, right? And you had more foreclosures and REOs on the market, and we were all investors going after them. That doesn't exist right now.
No,
because there was no money then, and the money that was available was very expensive. And right now we have appreciation, so we have equity, and we have money, and we have the stupidest cheap money ever. So those three things are keeping the market on fire.
I don't know how stupid the cheap money is, because there's stupid cheap money in the investment side. I don't know if there's a whole lot of there's cheap money and there's stupid money, but there's stupid cheap money on the investment side. We've already talked about that with investors maxing out leverage on their houses,
right, thinking
they're going to make a killing on it. I think on the retail side, I think there's cheap money, and I think it's relatively intelligent. Going back to not necessarily intelligent, but I think it's going to have a stabilizing effect to a certain extent. So we're not having ninja loans. We're not having no down payment. There's low down payment loans, but there's still, you need to qualify for it on an income basis.
That
back in the day,
you definitely hammer that home. I want to just right there. Add that to the fourth column. We don't have stupid loans. Right?
On the retail side.
Right.
We
on
do
the
have
retail
stupid
side.
loans on the investor side.
Absolutely.
To a certain extent.
Right. But we not on the retail side.
On the retail side, back in the day in 2004, 5, 6, we could do loans. The ninja thing was no job, no NI.
No income,
no
assets.
No assets.
Yeah. All you needed was
a
score,
right.
Basically a pulse, and you can get a loan.
You have a 800 credit score, you're getting a house if you can afford the no down payment because you have an 800 credit score. Oh,
right.
Well, because you don't want to screw up your credit. Well, when stuff hits the fan, if you have an 800 credit score but you can't afford to pay your bills, you have an 800 credit score because you paid off your credit card once a month for the past 15 years.
Right.
It's not because you're actually financially savvy and successful.
Right.
Now, if you can do both, that's cool. But that was stupid in the retail marketplace. What we have now is a little stupid in the investor marketplace, but is it actually stupid? So I think what I alluded to a second ago, one is, cash. cash offers on houses. We get cash offers on our houses. They're generally pretty good offers. We don't really care if it's cash, if it's lower, because we just want to make our money. But there is that much cash in the marketplace that needs to get placed. So maybe it's going to consolidate, and maybe the market's going to flop around a little bit. The issue that we maybe have long term is a sort of stagflation instead of inflation, so stagflation is defined as an increase in the asset prices without an increase in the actual economy or in the job force. So we're not really seeing an increase in wages as far as I know yet. We might have to a certain extent, and we're not seeing massive economic expansion. We're seeing economic expansion that's kind of sensible-ish, but we're not seeing those things correlate to the increase in real estate, mostly because of the free money. So if you have a whole bunch of free money, if you're making buy on having your $100, and all of a sudden someone gives you $25, you're going to put that $25 into the gaming machine. You're going to put it into whatever game you like, crypto,
Right.
stock
The
market,
casino, whatever. Yeah.
the casino, real estate, whatever it is. Now multiply that by however many trillion we just printed. That's going to go into almost a gaming effect into different submarkets. So even in gaming, there's different games are more or less risky, I suppose. In the short term, I think the upside is in something like real estate continuing to increase because of that supply of money. The risk is if we don't have an increase in economic productivity, and if we don't have an increase in wages, then we bump into, even with low interest rates, an affordability issue. And if we see an increase in prices and other stuff, then we're likely to see increases in Fed's rates, which then leads to less affordability in the marketplace.
I think they're petrified
I
to
think so,
adjust
too.
to adjust that rate.
But the problem
I
is-
think they built it up like a dam.
Oh, it's,
Well, that's the problem with what the Fed's doing with their money supply is we think that they just
Wait,
arbitrarily pick
wait.
interest rates.
back up with whose money supply?
Yeah, no shit.
Not with
even I
their,
slipped up on
not
that.
with their money supply.
With the money supply,
With
with our money
with
supply.
our money, right? And I think that people are like, oh well, they're just going to print more. No, you idiots! It's our money that
Yeah.
they're diluting, right?
Just devaluing
Yeah,
yours.
and but that's the economics of that you don't get taught in school. You don't get taught in college. Like you're just this. That's talking about bubbles. That's a bubble that needs to pop. Is the education bubble,
That's a
right?
different video.
But
Well,
that's a totally
definitely a different video.
Yeah, and it's a different concept, but it ties in just because it's relative to the buyers or sellers or whatever that we're encountering right now.
Mm-hmm.
But I don't know how. What I was trying to figure out was, okay, if you have markets that are decreasing in population. The coasts are decreasing in population, and they're going to employment-friendly states, Texas, Florida, whatever, Oklahoma, Tennessee. They're going to employment-friendly states, but you're not seeing a direct relation to that market's decrease in price. So you would think that if there's more people leaving California than going to California, that would cause California prices to go down.
Think of the clientele that's probably leaving those areas. It's generally people that aren't necessarily. So you see the big companies leaving, okay, but generally people that are leaving are kind of folks like my wife and I when we left before it was popular 7 years ago. Yeah, we were doing okay, but we weren't killing it out there. We left because we wanted to go somewhere else for a better opportunity. So
For a future.
Yeah, for a future.
Yeah.
There's still the coastal effect and still the retirement effect. People like living in Southern California and really a lot of California because of
Climate
of
and-
climate and weather and the beach and all that stuff. It's fun. I'd rather visit and have enough money to actually enjoy myself when I'm there. So that's the choice that we made. But there's still a
Just
decent.
don't forget your mask.
There's still a decent demand for those products, I think.
Yes.
And I think that's going to remain. I think the people that are tending to leave are more of the working, like kind of
That working
workforce.
class, that blue collar.
Blue collar people that want to own a house but can't afford a house in California. Maybe it'll drive down rent rates a little bit in the state. I don't know if it'll necessarily lead to like a right now impact in real estate prices. It definitely isn't. It might in a while. I mean, the coasts tend to wag the rest of the country, so the coasts tend to have the biggest fluctuations in prices.
Sure.
Just historically speaking, going back to the
Ever.
recession
Well-
post-war.
Well, you talk about talking about just 8 to 11. That quote unquote crash. What happened in California, New York? Let's just say it was a 50% decrease in value. Was a 20 or 30%, let's just say, decrease in Texas value.
Yeah.
What I stress to Nick and some of our clients is that, okay, even if Dallas lost 20% overnight, we are still up, in some areas, 3, 4, 500%, right? I mean, a house that I was buying for 50, I'm now paying 250 for. So that's 5 times what it was worth. So even if I lose 20% of today's value, that's someone do the calculation on that. That's nothing.
Well, and Dallas was significantly undervalued, kind of coming midway through Rick Perry's thing. I think he really transformed the state from an oil economy and from a kind of a single product based economy
To now, like, multiple,
everything.
right? A
Now-
very diverse
now
economy.
it is a very diverse economy.
Data, tech, a lot of finance, a lot of insurance, right? Like, that stuff is here because we built things that attracted those companies.
Yeah,
Housing,
and
nice
directly-
housing.
and directly courted that.
Yes.
Now, at some point, even Texas reaches a capacity where it's not necessarily feasible for another Tesla to move in. So maybe that means that we see an increase in smaller submarkets in Texas because of the favorable business and tax policy.
Right.
Or maybe it means that we see increases in other states like Oklahoma or, Georgia. It's a great one. Everyone likes moving to Georgia right now
Yeah.
because of favorable business policy and because of, relatively reasonable climate. And what I mean by reasonable is you don't get 8 feet of snow in Michigan. It gets hot as hell.
Yeah.
But you can turn on the AC and live.
Yes. Yeah. It's
And it doesn't stop planes from flying. It doesn't stop stuff
Right.
from coming in.
right. Yeah. I think we're just seeing maybe, without talking about. I feel like we've done a lot of negativity talk. The positive effect is there's like it's like a very balancing out, right? There's like the wild, wild west where the gold rush is on, where people are just expanding. They're just they're getting out of their comfort zone and they're expanding for one reason or another. And I think that's relatively speaking, that's a positive thing for things to kind of like level
Ease,
out,
yeah.
kind of give ease.
So one thing I want to bring up, because we were talking about the Fed, is their changes that they're making for the future, right? They're coming out, we were talking about it yesterday, they're coming out with a 40-year program right now.
Yeah. Which we joked about that there used to be 50-year loans and you don't see them anymore. But now we're starting to stretch.
Do you think that's them trying to prepare and get ready to hedge their bets? And
Yeah, I think so.
you
I
wanna
think
start?
I think a lot of the newer investors were thinking there'd be a flood of foreclosures when the eviction and foreclosure moratorium ends. And if you do the math on the projected number of defaults, FHA has an incredible amount of non-paying loans right now, which is unfortunate. But if all those loans hit the market right now, it would be something like 9 to 12 months of actual inventory. Generally, that's considered a maybe lower end, but a healthy market. It's not a 3 years worth of inventory like we saw in 2010. It's more inventory. Right now we have, if you price your house right, you have 6 hours worth of inventory. If you price it wrong, you can still overprice the crap out of your house and not have your house moved.
And you have a
So
you have a
gotta know your
2-week
market.
inventory,
Yeah.
right?
Yeah.
So I do think that there is a lot of hope, and not in that really evil way, but there's a lot of hope that there's going to be foreclosures, because then investors think, oh, well, that's inventory and I'll be able to have access to more deals and maybe pricing will come down. That is not coming.
There's too many sharks. You can't have that many sharks in the water.
I was talking to a friend of mine the other day, and he's a hard money lender, and he's one of the smartest guys I know. And I said to him, that is not coming, just like that. And he said, I agree with you. And I said, if you're unlucky enough, and really what I truly said was, if you're stupid enough to go into foreclosure right now, you deserve it. Mm-hmm. If you are dumb enough to let your house get to foreclosure right now with the resources that are out there, the equity that's out there, the access to capital, or private lenders, or or a realtor friend who
one of
can
the- one of
put
the
your
keys-
house on the market and sell it for a profit.
One of the keys that you said was equity.
Yeah.
There's a lot more equity in the market right now. Now that can, if prices come down and there's a deflationary period, yeah, a lot of that equity can vanish.
Yes.
So then maybe we get to a equity neutral standpoint. But getting into a negative equity position is going to be really difficult in this market.
In Texas specifically.
Well, especially in Texas, but I think almost nationwide to a certain extent. What you brought up with the 50-year, 40-year mortgages coming back into the marketplace is, like it or not, I think we've actually learned a lot from the 2008 financial crisis on the banking industry. Now, the Dodd-Frank thing, there's a lot of stuff in there that's really kind of stupid.
Pain in the ass. Yeah.
But yeah, the pain in the ass, a lot of unnecessary regulation just for the sake of regulation. But the banks were not prepared for what happened in 2008, 2010. They didn't know what they were doing. They postponed foreclosures longer than they should in a declining market in order to basically make their books look more profitable than they were for a lot of like internal regulatory reasons. So there was a lot of shadow inventory at the beginning. Now there wasn't kind of a second wave of shadow inventory that people talked about was going to hit the market. Right now, there's not a shadow foreclosure wave because of exactly what he's talking about. There wasn't equity in 2008 because, yeah, there was a drive up in prices, but there was also free money with no qualifications to the free money. Now, unfortunately, we do have free money on the investor side in a lot of cases. It's not free money, but we have cheap, easy money. So we see maybe a shakeout in something like that. But on the retail side, there's not as much, like you said, you got to be dumb to go into foreclosure right now, or you got to be just incredibly unlucky and pay at the top, and then all of a sudden, right now, go into foreclosure.
But the crazy part is in 6, 7, 8, 9, 10, 11, those years, you were dealing with what they called subprime borrowers, right? That didn't always make the best decisions, but also were being given what you called stupid loans, right? Or we called stupid loans. So no down payment, right? The buyers, when you sell your house, when you look at that contract, they're almost every single buyer that I've looked at a contract for in the last 24 months is bringing some form of money to the table, which you used to see zero, right, on some of them back in the day. Now you're not seeing that. So they were vested. People are being asked to be vested in that decision to buy that asset.
Right.
The thing also...
And we're seeing probably cash offers. Well, we're seeing cash offers on all of our houses, but we're probably taking cash offers on 15 to 20% of the houses that we put on the market.
Yeah.
And
this is the first one I've actually accepted.
Okay. Yeah. We've accepted quite a few in the past year.
This is the first one I've accepted just because they actually came with an incredible story, which is another video. But
isn't that cute?
Yeah.
You fell for the cute letter.
Yeah.
It's a softie. Look
We
at
can
him being a
actually
softie.
talk about that one just because the fear of it, right? Like, I promise you that person paid 25 more cash offer just because they've been getting their ass kicked by the funds, losing out on deal after deal after deal.
I also think the product that we sold
Worked for them,
yeah. Right? Ideally, in the market that they're in, it was the perfect product. So it was literally the perfect storm for them to pony up for this specific house. But what I wanted to touch on, and I think I've said this in multiple videos now, the thing that the Fed did in
this time.
So this time in 2020 when they came out with all this COVID stimulus, all the stimmy money, the thing that they did very, very well this time, and I don't know if it was a conscious decision or not from what they learned from the 6 to 11 era, they protected everyone's credit. No one was protected previously, right?
Absolutely
in
not.
8, 9, 10, 11, you had a 750 client, they missed one payment because of something happened or they lost their job or whatever, and they went from a 700 credit score to a 500 credit score. They couldn't requalify, they couldn't get a loan, they couldn't anything, right? They protected everyone's credit. No one was allowed to be reported late and it affect their score.
And there was one other thing that was huge in the previous kind of market, was a lot of the loans that were out there were adjustable rate, which was nothing necessarily wrong with that. There's 5-1s now, there's 7-1s, there's all that stuff now.
Yes.
But what the banks didn't do was, okay, you're going to adjust the rate, and now the payment goes up 40%, where you can afford the payment, where it was. Now I can't afford the 40% payment because the economy's bad and my business is shit and all this
Right.
other stuff. I could afford the other payment. So now the bank doesn't want to loan mod you, because of either some internal thing or some Fed regulation I don't even know about. So now you're in foreclosure. So what the banks really did in 2008 to 9 was push for more foreclosures unwittingly because of a bunch of just stupid internal policies
Yes.
in the banking industry.
Yes.
There's different stupid policies right now in the banking industry, but I think that's more on the small business side and in the SBA side. It's not so much on the real estate side. I think the real estate side has learned a lot from the 2008
Sure.
from the 2008 kind of
I would agree
crisis.
with that. I think they realized, which could play into the 40-year mortgage. They realized that it's a very stable investment. If you make the loan not cheap enough, but like smart enough, almost mortgages for dummies, right? If you don't mess with them, just give someone a target, and the average person's going to get relatively close 90% of the time, right? And so if you don't, doing a 2-year balloon or something like that, or a second that balloon, that was the other thing.
Well, I forgot about the balloons. There were a lot of
right. There
balloons
were a
on the
lot of
market
secondary
before.
balloons. So you took a first
Right.
at 80%, the other 20% was on a 2-year or a 5-year balloon. So your first payment was great, and you could afford that first, and then the seconds, all those banks that had doled out seconds, so that you had no money down or no less PMI, whatever it was, those loans ballooned, and
Right.
that caught people, right? That bit someone. So
Yeah, there's a lot of cases of that. I mean, and seconds were selling on the secondary market, sometimes for a penny, penny to the dollar of the balance.
yeah,
So
like there's
insane
there's basically no default market right now.
right.
There is almost virtually no default market right now, unless we hop into commercial, which I know nothing about. Do you think the 40-year, right? So it's not, so no, you're not going to be able to call your mortgage broker and get a 40-year loan right now. That's not what we're talking about. But they are playing with, and it's actually, if you read the article right, they're not playing with offering 40 years from the get-go. They're playing with modifications for people to go to 40 years. And I think that that's something also to touch on, that one of the reasons why we're not going to have a ton of foreclosures right now is because they're actually giving these modifications. Now you have Ginnie Mae specifically toying around with, hey, what's the appetite going to be like on the secondary market for a pool of 40-year loans? That's what they're toying with right now. If that's successful, which I don't see why it wouldn't be, there's enough, as we talked about, liquidity. Someone's going to throw their money at it. So there's going to be some bond buyer that buys that 40-year pool bond. If that's successful enough, that could roll over to Fannie and Freddie and conventional offering 40s. I don't know if that's positive or negative. I know my gut's telling me, but I think what that does is that gives us the ability to keep increasing in price.
I think so.
Because as you prices go up, if you kick the loan out, the payment's relatively speaking going to stay the same, right? So I think that's going to give us, especially here in Texas, the ability to keep appreciating, right?
The issue with obviously all that is the unknown market dynamic of what interest rates should be doing based on the increases in monetary supply.
Yes.
So, again, going back to the dollar is crashing or tanking or whatever, you got to consider as opposed to what? As opposed to the euro, it's absolutely flat. Same with most kind of westernized, traditionally stable-ish currencies.
Well, and we
we're-
talked about that though. What's happening in other countries where they're not opening?
Right.
There you have it. Without getting into the news and geopolitical, let's not open that box. But if you go outside, yes, our market is tied to other countries and stuff because of commodities and trades and yada yada yada. But these other countries are not working. Right. They're not open. So what does that do? I haven't drank in 2 years, but what's an Italian wine cost right now? Did the price go up on wine from Italy because they're not working?
Price of scotch is going up. I don't know about wine.
Well, so that's right, but why?
Yeah.
And is it
Well, and is that a disruption in the supply chain with a supply constraint issue and causing inflation?
right?
Or is that an overall a broader issue that's not going to get worked out of the marketplace?
Exactly.
So that's where if everyone's, I guess all I'm saying is it's a false argument to say, oh, the dollar's going down, when you don't have a basis of comparison to say what's it going down against. Going down against the iPhone, no, it's not. Going down against the 2x4, well, that's a supply issue.
Yeah.
Going down against the euro, again, no, it's not. Going down against other commodities, then you got to look at, well, is it a supply? Is it a macro supply issue like oil? Oh, there's a ton of oil out there. So then is it a micro supply issue where we're going to constrain the supply because of regulation that's going to cause prices to go up? So I think just saying, oh, such and such is happening, yeah, I understand that. People love binary causes and binary effects.
Direct.
Direct binary.
That direct.
Like it either is or isn't this.
Mm-hmm.
And it's generally, it's a simple solution for a simple mind. The problem is it doesn't actually work that way in
There's a lot of gray.
Global market. On the other side, you don't want to overcomplicate and over-attribute effects that aren't really actually having an effect. So you gotta hone in on what the actual causes are, because there are actual causes of different price fluctuations.
What does this mean for you? Like if you were to carve out the next, let's just say maybe the end of the year, what does this mean? What is everything we just talked about? Are you adjusting your business as an investor? Are you changing, hey, you know what, I'm going to adjust for the next 6 months, and then I'm going to reevaluate in December or January and see where we're at, right?
So we do obviously pretty much all established investors do short-term and long-term products, I guess. So short-term with flips, again, I just said that we added a little over 100K just on stuff on the board when we went through all of our projects and say, well, let's reevaluate the ARVs because we just haven't bothered to change them. So that means we're going to keep trying to buy stuff and resell it because it's a great market for that. There's a ton of money in the market for doing that. A thing, too, that we really are doing right now is going to be buying more rentals because right now 30-year fixed rates, non-conforming, non-QM financing or whatever, are in the, mid-fours? Mid-fours.
Low fours.
Low fours.
High threes.
Now I need to refi.
Yeah.
Shit, I just pulled out a whole bunch of money. Now I need to refi. That's going to take the place with some of the new constraints in conventional financing. Those same folks are now going to go to the investment financing. Now, what's that going to do long term? That might not necessarily be good because there is some stupid money, like I said, on the investment side, on the non-QM side.
Yeah, and I don't. I think those funds, as you know, we do that, right? But I think those funds are being pretty intelligent about the way they're weighting those deals.
I think they're doing well on the long-term products.
And
absolutely.
they haven't. I was in that sector in, let's just say, 2006, and they were not that intelligent.
No,
they were not that. These loans were what you're looking at today. What you just got on your rentals that we just did for you was nowhere near the quality of a loan that was out there in 2006.
Yeah, I completely agree with that. So more money supply in the long term is going to increase prices dramatically. Now, are we going to have decrease in prices maybe 3 years from now because of other economic factors? More than likely.
Sure.
But that correction is going to be from 20-30% higher than where we currently are.
Right.
So anyone looking at the market right now, I like making big paychecks, but every time I sell a house, I almost think, well, shoot, do we actually need the money? Because we really should be locking in these low rates right now while they exist. And I haven't seen, I don't know if you guys have seen, I haven't seen non-conventional financing for 30 years, like for a 30-year product until recently, until the past 6 months. We would usually see 5-1 arms or 5-2 arms, something like that. So then you're projecting out, well, this house that I have, I'm going to need to look at refinancing in 5 years. And what if interest rates are higher? Now I'm screwed. Now my cash flow is going to be goofed up. Now there's a lot of uncertainty, on that side. It's part of that contributed, I suppose, to the last financial crisis with the ARMs. Yeah. Because interest rates were, stuff was different. Mm-hmm. So if I can lock in, 4.25%, 4.5%, 30 years fixed.
If you could lock in 6 years, 6%, 30-year fixed right now.
Yeah, absolutely.
That is still stupid. Rate, yeah. Even if you could lock in 10% 30-year, right? The rate in itself, and I know I bust your chops about this because we talk about rate, right? And it's like, well, what's smart? Any form of fixed rate is smart,
right?
As long as you're not over leveraged, and as long as you're not over leveraged, the rate doesn't matter because there's going to be some sort of income. Theoretically speaking, from that property that would cover that for you.
Yeah, and there's going to be an equity buffer.
If you're the investor that doesn't have the equity buffer or isn't buying it at with the ability to make money on it, or you're the investor that's living off of that slim cash flow,
then there's an issue.
then that's the investor issue.
Then a decade
right?
from now, you're going to be selling me your house because you screwed up.
Or the bank's taking it,
No.
or the lender's taking it, right?
Right.
So yeah, no. So if you're, I think one of the thing I think that we need to give is liquidity is important, but a balance of liquidity, a balance of keeping some money in your bank, not too much. Don't hoard all your cash right now, but deploy it into the right asset with the right interest rate so that you can cash flow and kick your future wealth, right? And give that a boost.
Well, with the non-conventional financing, what's the max cash out? So
75.
okay,
75%.
There's 25%.
Absolutely.
Back in the day, the max cash out was
Like 90
well in Texas. Texas always had that 20% thing with the cash out generally
on the homestead.
On the homestead, yeah, but not on regular,
Right.
not on like investment properties.
Yeah, you could do
So-
an 80-20 and 100% finance.
Exactly. That doesn't exist very well in the marketplace.
Right.
Now, you can get it. Like, I mean, you and I both buy houses without any money out of our
Yes.
pocket kind of thing. But that's because of our relationships with
And-
people that we know.
And we're making deals
Right.
unlike anyone else.
Right.
Right? So the average person out there isn't making the deals that you and I are making.
Right.
Right? They're buying, they're working somewhere and they're buying and they're, using hard money, which is a good thing, but they're not daily users like you and I are. They're not evaluating the market constantly.
Right.
I know you're very similar to me in that you're constantly thinking about the market, what's trending, what's coming, what just happened, what just sold, what's where you just did it on your portfolio and you found 150 grand, right? So that's something that me and you were doing, and I not everyone else has access to that data or the time to do that, right?
Or if you're doing one deal,
You're locked into that deal.
I don't know what that means, doing one deal.
I know.
If I'm doing one deal, I'm stressed.
Yes.
Because if something goes wrong, if we messed up
Mm-hmm.
on any step of the process, acquisitions, renovation, dispositions, financing, holding time, projection of where the market's going to be in 6 months, that's the one that even, you get a little worried about when you're doing 20 deals.
Yeah.
But if you mess up any one of those steps, then, you have a big problem.
Yeah.
Because now you're counting on that 30K you're going to make in 6 months to live on. If you're doing 20 deals at a time, you're really spreading your risk out across multiple assets.
Yeah.
So if you have a solid acquisition strategy, then hopefully you're buying right. If you have a solid acquisition strategy, generally you're going to have solid construction and solid products for the renovation. And then you're generally going to be relatively comfortable with what the market's likely to do, currently, and what it's likely to do in the next 3 to 4 months, because
Yeah.
we're not holding these things for a long time. So then if you get a bad house, because you get bad houses,
Yeah.
then it sucks. That bad house takes out one
hurts.
other house.
I love
Doesn't
that.
kill you.
I love that.
Yeah.
I love we joke about this because we have investors that come to us for financing and they say, "Oh man, I can't lose on this deal," and I chuckle because I'm like,
That's
You want-
scary. I
yeah.
could lose on any deal
I
I
could
got.
lose-
I can't
You
lose
want
on
me to
all
tell
of
you
them.
how?
right,
'Cause that would
right,
suck.
right. But I can lose, and people are like, "Oh, Tony, have you you've doing this a long time? Have you lost money on a deal?" Absolutely.
Yeah.
Really?
No offense. I tend to not trust people who haven't lost money on a deal.
Well, and it's because either you haven't done enough, or you're being so conservative, or you're not really being truthful with your numbers. We joke about that when people post their profits on social, where they post their gross all the time. I don't know any investor out there, and I challenge everyone, there is not an investor out there that posts their net profit on a deal. And I think
because on the same deal, my net profit is because they're trying to flex and brag.
I get it.
But even then, my net profit on some deals is going to be better than your net
Most
profit,
people's-
or your net profit on some other kind of
Yeah.
deal is going to be better than mine.
Yes, yeah. So I think so. Okay, so let's tie this back into just the where are we going from here to the end of the year? Is there a give that we have to give to everyone out there? Maybe stop falling for the cheap money. Don't get emotional about the bidding process,
Sure.
right? Maybe that's the give for the next 6 months.
So for the next 6 months, don't confuse a consolidation in the marketplace, which is the technical kind of economic term for what's likely to happen, with a crash. Crashes are caused by external forces that dramatically change the way the market operates. and I mean, it's not exactly external, but whatever. But think about a Bitcoin crash or a crypto crash, because everyone's got that in their mind. What causes a crash? Apparently, Elon Musk going in and saying, "Oh well, I don't like that anymore." That causes a crash. Now, is that a sensible cause? I'm not sure. Probably because of the type of asset it is. But generally when there's a declining, actually declining market, there's a significant kind of news changing effect that's going to dramatically change the dynamics of the marketplace that wasn't there, manifesting itself previously. It doesn't mean it wasn't there. It doesn't mean it wasn't building up. But that's what causes the thing. So 2008, Bear Stearns goes belly up, Washington Mutual goes belly up, Coastal Banks,
Lehman Brothers, right?
Lehman Brothers goes
massive.
belly up. All these massive things. Those are catastrophic news causing events that changed the dynamics of the marketplace.
And that was legitimate money.
Yeah.
That was legitimate money missing, disappeared.
If we have that happen, then all bets are off. But you'll be able to point to that event.
Mm-hmm.
Now, is a COVID mass layoff that event? No. Some of us thought it might potentially maybe be, depending on how bad COVID was. So, internally we shut down marketing for 2 months, and then we kind of looked around going, well,
The sky's not falling.
the sky's not falling, screw it,
Right.
let's go.
Right.
And we were one of the first back into the marketplace, and we made a killing by buying a lot of deals that other people weren't looking at.
Yeah.
So that's in the next 6 to 9 to 12 months. What's going to happen 5 years, 10 years down the road? We're going to have a recession. We're going to have resets in markets up and down. But what we're also going to have is more play. I think the biggest risk in the real estate market right now is what I'm calling the commoditization of the national real estate market to a certain extent. So what that means is, I think we're not going to see mass exodus from cities that are just sensible cities because people like living here. But as people are able to work from home more, as tech improves, as virtual working becomes more and more accepted, now we're going to see people being able to live not in downtown Dallas. We're going to be able to see people live in 20 miles north in some place like Plano and Frisco. Well, okay, now you live those places because it's built up and there's economies there.
Yeah.
But what happens when I want to go live on my 5-acre farm, an hour out in the middle of nowhere, but I can virtually work because of Zoom? Well, now I can do that. So I think we're going to see that. So that's not necessarily risk. I think that's an opportunity for investors to go look in areas that they might not otherwise be looking in.
Yeah, look under the rocks and find those other hidden
for
gems.
kind of stable products that haven't necessarily been considered stable until kind of recently. And what we're going to start seeing also is, with those same increases, we're going to start seeing these funds move into these smaller submarkets and start actually competing in that area too. Because up until recently, most of the funds have been pretty happy with 1985 and newer, 3-bedroom, 2-bath, 4-bedroom, 3-bath. They're not playing in the 3-bedroom, 1-bath in Longview or Sherman. It's like they're not really interested in that.
They didn't want frame houses. They wanted brick.
Right.
They wanted like a certain type.
Right.
And that's been there, like you said, for the last 15, 20 years. We were selling to those funds back, then. We were selling to those funds now.
Right.
But now there's this other competitive fund in this other market that wasn't there.
So, yeah, what we're going to continue to see is we're going to see big players that have just billions and millions of dollars to buy up dirt.
Yeah.
That doesn't make a lot of sense because they have money that they need to place somewhere. We're going to see funds that need to make a return for their investors start to see, well, shoot, I can make a 0.5% return, a gross rental to price in Dallas or whatever on the marketplace. Well, I can make a 2% return somewhere else. So even if I'm really shitty at managing it, I'm still making a 1% return. Well, hell, now I'm a genius.
But what does that do for you? What is
for
it?
me?
What is that? What is that? How does that change your business? Because you have people, right? You have a company. You have people that are counting on you for the direction, right? The stress of you as the business person, as the self-employed business person. What does this do for you for the next 6 months or 12 months? How are you gonna transition? What's that look like?
Well, if you're walking around 112 units when you're 24 with a Nokia flip phone, and you're sending pictures back to investors or whatever, it takes all afternoon to upload 2 pictures.
Yeah.
Right?
Yeah.
Now you pop on Facebook and be like, oh, let's do a Facebook Zoom live call, video, whatever. Let's look at all these problems here. It's never been easier to do stuff not in your local market.
Yeah.
And I like the local market. I think Dallas is a great place. We do obviously a lot of business here. But I think it's also never been easier to go Partially because of COVID, there's the expectation of not having to be in person for everything.
Yeah, virtual.
But also because of the tech, same thing that the big guys, the big hedge funds are seeing too, is it's never been easier to really have management almost virtually.
Mm-hmm.
So that's going to change the dynamics of the marketplace, along with everyone else buying stuff. I mean, there's conspiracy theory news sites about they're trying to turn everyone into a bunch of renters and make them happy. Is it a big conspiracy, or is that just the way the money's going to flow, where big people with a lot of money are going to need to place their money places,
Yeah.
and it's now easier to manage that money in these different places where before it hadn't been as easy.
Yeah.
So I'm going to buy rentals. Kind of weird. I'm going to buy rentals in places I hadn't thought of buying rentals before.
Sure. So you're going to evaluate submarkets
Mm-hmm.
to diversify your portfolio and look at like long-term cash flow
Right.
instead of just short-term gains.
Now that doesn't mean that a market with 1,200 people with burnouts is all of a sudden going to get revitalized. Don't be stupid.
No.
But a market of 50,000, 100,000, 200,000 people, there's reasons people live in those places.
Yeah.
And it's fun reasons. There's the country lifestyle. There's more freedoms and opportunities to go just be free or whatever that means. I know we all kind of like our
Privacy.
golf courses and all that good stuff.
Yeah, but
But-
some of these submarkets that we're referencing in Texas are they're not your small town,
No.
right? They're not.
It's
not-
not tumbleweeds. And
Yeah,
stuff.
yeah,
No,
it's
an actual
not.
city.
There's
Yeah.
actually cities. There's actually things happening there, whether it's colleges or right. You're not. We're not in rural, right? I think there's a difference between rural and submarket.
Yeah,
right?
there's rural, and then there's a secondary,
Right.
or even to a certain extent a tertiary market.
Yeah.
I'm not really sure where the breakdown is on that. But if the city's going to be there in 50 years, then people are going to want to live there. And I mean, heck, you can look it up. Look at the demographics on the population increases or decreases. If the population has remained stable or increased in the past, half century, then the likelihood of that town being a kind of solid investment going forward for the next 20 or 30 years is probably pretty high. If the population has declined by 30, 40% in the past however long,
12
then,
months.
Yeah, then be careful. And be careful even in the submarket of other metro areas, because you don't necessarily understand the dynamics of a type D submarket in one type of city might be different than a type D submarket in a different type of city.
Well, and a type D market in California
Mm-hmm.
is not the same as a type D market in Texas.
Right.
Right? Just because they are labeled the same type, that they are not the same.
Yeah, so you also have to look at the fundamental risks of investing in any area.
Sure.
The fundamental risks of $1 million house are different than the fundamental risks of a $100,000 house, but the fundamental risks of a $100,000 house in Dallas is a lot different than in Memphis and Florida.
Mm-hmm.
There are $100,000 houses in California.
Yeah.
So in any of those markets, unfortunately, if you live in a state like California, you also have to consider, to a certain extent, the risk of increased federal regulation on your product. But you know that when you live there, so take that into account.
Yeah.
And don't over leverage.
Whew, that was a lot. We covered a lot of information there. Hopefully you guys enjoyed. If you have any questions or comments or anything, just like, subscribe, share, post a comment below. Thanks for TJ for coming in, and keep going.